Happy.
How are you?
Hello.
Great scene on your policy. I know everybody pulls their policies out and reads them all the time. Ever seen the words all risk? Well, all risk technically doesn't mean everything's covered. There are 3 levels, if you want to call it, of property insurance. There's basic, broad, and there's special. Well, special is also known as all risk. Basic, there are 14 basic named perils. Wind, fire, so on and so on. You can Google them. Google's a really neat tool. Basic peril insurance. There are 14 basic perils. The burden of proof for basic and broad, which adds 11 more named perils to your coverage, the burden of proof is on you to the insurance company to prove to them that which caused the damage is one of those 25 perils. Special all risk form is just that. Unless that which caused the damage is excluded, then it's covered. So now the burden of proof is on the insurance company to say, no, it wasn't this, it was this. Now granted, there are tons of exclusions. That's the one thing everybody should read is the exclusions. Earthquake, we're in California, you can usually buy earthquake coverage, either separately or through the policy with the program that you have. Water backup, flood, you got to buy flood insurance through the National Flood Insurance Program. The bottom line is special form is the most comprehensive form that you can get. So when you're out quote unquote shopping for insurance, don't let them slide that by. That's one thing you should look for. Is this special form? Is it basic or broad? I'm not saying basic or broad is bad. Just know what you're dealing with because the premium differences are fairly significant between those 3 levels of coverage. If it's an old beater house that you're going to own for 90 days, fix it up a little bit and flip it off, then maybe you just put basic form insurance, cover the fire, cover the windstorm, take the chance and move on. If it's something that you're going to hold on to me that special form is probably worth having. In the long run, especially. I always like that. Clip art's pretty cool. That's actually a good one. A 9-year-old helped me with this. She did pretty cool. Yeah, well, there's all those exclusions. One quick thing on the exclusions. There's one coverage, I call it the hidden coverage, the unknown coverage. Anybody here, I know you've got some multi-units. You've got a 4-family. Unfortunate incident, a fire hits one of the units. Well, thank goodness all the damage was relegated to that one unit, smoke and otherwise. Contractor comes out, insurance adjuster comes out, and everything's looking good. You're as happy as you can be after a claim. Then the building inspector comes knocking on the door and says, well, wait a minute, everything looks good here, but this is a 40-year-old property. You're going to have to upgrade these other 3 units. There's a coverage called ordinance or law coverage. You have to pay for it. It's typically excluded, but if you pay for it, it would pick up the damage to the other parts of the building that weren't damaged in that fire. Looks like you had a question.
Is there an age factor on a property that they just won't insure, period?
You mean for that coverage or for
in general?
As I stated a few minutes ago, you can get insurance for just about anything if you're willing to pay a premium for it.
Okay. If the barn's leaning too much, they don't tend to.
Yeah, it's kind of tough to do. You can't buy a claim, as they say. That's why they put the moratoriums on when the wind starts blowing on the coast and all that other stuff. So yeah, you can get it. Again, we're dealing in a world of insurance that's very niched with the programs and the carriers that we work with because we're dealing with real estate investors. So we've done the work that we've done with them through the years has really been a sales job just to convince them that, hey, with our client, we're not dealing with clients that's buying a dilapidated building and let it sit there and turn into a crack house or a brothel. That's not what they're doing. Nobody makes any money doing that. Well, you could, but it's not very big or moral. We make money when we do what? When we get somebody in there fixing the thing up and we either get it sold or we get somebody in it to rent it out. So we've convinced our carriers and our carrier partners of that deal. So really age hasn't been too big of an issue. It might diminish what opportunities we have for deviations or for coverage discounts, those types of things. But no, age really is a deal. In other words, if you're going to go in there to get it livable or habitable, now that's the whole point. That's what we want. Okay. And anyway, sometimes I'd rather see that 100-year-old house with brick walls this thick anyway. Yeah, exactly. It's not going anywhere in the big picture. Anybody in here self-insured? I can get you. What? What's that? Well, actually we all do. We all carry deductibles, right? So the deductible is an inherent form of self-insurance. My rule of thumb has always been, with points of diminishing return, you roll the dice a little bit, thin ice. My point is, carrying a deductible, the minimum claim you ever file times 2. So if you've never filed a $1,500 claim, then don't carry a $1,000 deductible. Believe it or not, even when their deductibles are low, that's more advantageous to the insurance company. Why? Because they charge a high premium. You have a $12,000 claim and a $1,000 deductible or $2,500 deductible. You know those people who go out and settle claims? They're called adjusters. They adjust things. I'm not saying they cheat, they do anything like that, but the point is, they want that high premium coverage. My point is, don't give it to them. You know you're not going to file a $3,000 claim, then don't carry it. $2,500 deductible. If you go across your portfolio or across your insurance world where you want to put it, and again, within points of diminishing return, for instance, on our vehicles, we got 2 newer vehicles, minivan and truck. And to go from a $500 to $1,000 deductible, believe it or not, only saved about $30 a year for our 2 vehicles. Well, knock wood, we haven't had a half-fault accident in 10 years. We should have been saving that money and gone to the $1,000 deductible. But the point is, if you would go across your insurance world and start looking at raising your deductibles, you probably save enough premium in the course of a year or less to offset one of those claims. In other words, you go from 1,000 to 2,500, and if you've got 12 properties and 3 cars and a house, and you raised all the deductibles, I'll bet you save that difference in premium just in year 1.
What was that rule that you gave?
Take the minimum claim you'd ever file and double it. Again, within reason. I mean, if you never file a $2,000 auto claim, but to go from $1,000 to $2,000 deductible saves you $4, then it's not worth saving. But that brings up another point. Every now and then, whether you go to an agent to do it with you or you do a little bit of research on your own, just go through the policies and get rid of some of the coverages that you're paying for that you really don't need. Quick, for instance, this is it's relative to the real estate investor world. But if you've got 2 newer cars that typically have what today? Roadside assistance or towing type coverage, and even some of the nicer luxury cars will even come pick you up if it's in the shop and not using one of the rentals or whatever. If you're paying $15 or $20 every 6 months for rental and towing coverage on your policy, why? I had clients with 4 cars, 2 drivers in the house, still paying for rental on all 4 vehicles. Can't you drive one vehicle? Yeah, probably could. It was $80. I don't know about you, but $80, $80. Might as well save it if you're never going to use it. So self-insurance, again, that's a myth that it's too risky. It depends on what it is. What's a catastrophe to you may not be a catastrophe to me, and vice versa. Again, kind of know when you should self-insure, know when you shouldn't. You've got a $10,000 building out there that you just paid for to burn out or whatever, and all you've got at risk for 90 days because you're going to wholesale the thing is $10 grand and some liability exposure. I'm going to touch on that here in a little bit. Then maybe you do self-insure that. The one thing I don't recommend self-insuring is liability, because on the property you've got what? A known risk. You know it's a $10,000 bill. You know it's a $200,000 structure. Well, if you can stomach that because you've got that kind of cash, it's good for you. But the one thing you can't predict is the amount of the liability claim. You don't know who the neighbor kid is that got bit by your tenant's dog. You don't know, God forbid, somebody's going to get killed in a fire on your properties, whether you're at fault or not. That's still liability protection. The other thing I will tell everybody right now is if you ever hear of, sniff, or think that there's a potential liability claim on one of your properties, don't try to settle it yourself. I had a client, again, before they were a client, had little old lady Johnson, nicest tenant in the world. She's been there 25 years, and she slipped and fell into ice. This is back in Ohio where we get ice and all that kind of stuff. You don't get it here that often.
No.
Nice. You make the drinks?
Yeah,
Right.
that's about it. Slipped in the landowner, the property owner, went to this company, you've been a tenant for you. Why don't you let me take care of your medical bills, your trip to the doctor? Oh, that's fine. She appreciated that. And then about 3 months later, the landlord, property owner, got a letter from an attorney. Well, at that point, because they stepped in and they didn't do what they were contractually obligated to do, and that's notify the insurance company. The insurance company did this.
Oh, geez.
Good luck. And they should have, because technically, and it stinks, but when they go to Mrs. Johnson and sell that claim for $5 grand, bogus or not, I'm not saying her claim was bogus. We get clients, why did they sell that claim for $5,000? Because it would cost them $15,000 to defend. And when you pay that premium, you're also giving up that right to defend. So no, it's the insurance company's call at that point, not your call. But my attitude is, Mrs. Johnson slips, the first thing I'm doing is calling the claim and take care of it. And if one of our clients calls us and asks us that question, I have a contractual obligation to carriers to notify them, put them on notice. It stinks, but that's a system.